Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be exploring the topic of why do stock prices go up and down. So this is something that we get a lot of questions about all the time. It's a video topic that I've been very excited to do here for quite some time now. So what I want to do today in this video is I want to really explore everything you see on the news every day, with the entire stock market and individual companies, and why do stock prices go up and down? What are the factors going behind that, and whether you're going to go out and actually buy those individual companies on your own, or you're going to buy a mutual fund or an ETF that buys stocks. I think the information in today's video is going to be very valuable for you to kind of get a better understanding of maybe how the entire stock market works. So let's jump right in. So at the very center of why stock prices go up and down are the very basic laws of supply and demand. And the laws of supply and demand are kind of the cornerstone of most economic principles that are out there. And when we think about it in terms of stock prices, if we essentially have more people that want to buy a stock than are willing to sell that stock, then prices will move up. And if more people want to sell the stock than are willing to buy, then prices go down. And so the idea here, as you're matching buyers and sellers and the prices they're willing to pay for that, you're going to equalize the price so that the number of buyers matches the number of sellers. And that's essentially the crux of what's going on in the stock market every single day. But of course, we're not going to just end there. We're going to take a little bit of a deeper dive as to what are some of the factors that may influence how many buyers may be out there and how many sellers are out there. And to do that, what we're going to do is we're going to turn to our good old friend Warren Buffett, and I've used examples of him many times before in some of our videos, and he's got some excellent wisdom. And if you've never really studied Warren Buffett or kind of read some of his things or watched some of his video clips that he has up on YouTube, I think anybody that's investing, whether you're out there buying individual stocks or you're investing in mutual funds or index funds, I think that you can learn a lot from Warren Buffett in many, many different ways. So Warren Buffett talks about something called intrinsic value. And the intrinsic value of a stock essentially is the present value of all of its future cash flows. So maybe to kind of back up here for just a quick second, if we thought about things in terms of a bond we've talked about in other videos there, but a bond is really just a series of coupon payments. And so for bond pricing, it's relatively easy to calculate the price of a bond. We know that we're going to put a certain number of money into that. Maybe it's $1,000 for a bond, and then we're going to get some money back maybe on somewhat of a frequency basis. Usually for a lot of bonds, it might be 2 times a year you're going to get a coupon payment. And then at the end, you're probably going to get your $1,000 back. And that's going to be over a preset period of time. So we know that might be, if it's a 5-year bond or a 10-year bond or whatever the case may be. And we can very quickly calculate the value of that bond, especially if we say, okay, the interest rate today is 6%, but maybe tomorrow the interest rate goes down to 5%, or if that interest rate were to go up to 7%, and we can just rework the math here relatively easily. So one of the issues comes in on stocks is we don't really know what the future value or what the present value of those future cash flows is, I should say. And so with a stock, we're going to have earnings or profits that company is going to earn based on the amount of money that they're making from the goods and services that they sell. And that can change pretty wildly from one quarter to another, or 1 year to another, or even how things might evolve over the next 10 years. So everybody is out there basically trying to guess the same thing. They're saying, okay, we might make $5 per share today, and we know that maybe in the past they've been growing their earnings at 10% per year, pretty good earnings growth rate, and we would try to figure out where would that be next year. So if we're talking, let's say, about a company like Apple, everybody's trying to figure out how many iPhones they're going to sell over the next year. Is the new iPhone going to be something that people want? Are they going to come out with something that we don't even know that we want yet? Apple's very good at that. They come out with things that, I didn't know I needed an Apple Watch. I didn't know I needed Apple TV. What are those products? And do we like the management of that company? And are we confident that they're going to be able to continue to build that market share or to continue to develop those products that people want? Okay, so let's talk about some of these factors that are going to influence what we think that present value of those future cash flows are going to be. So one of those obviously is the price per share that we're going to pay for that right now. I think it's very important, though, not only to look at the price per share and not simply say, hey, this stock is a $50 stock and this stock is a $100 stock, so I can buy more shares of the $50 stock, but we want to look at that price relative to the earnings of that company. And that's probably one of the most fundamental kind of value indicators. So how much are we getting in earnings for each share of stock that we own? So basically this evolves into something called the price to earnings ratio. And it's probably one of those things that I think is a very good indicator. I think Warren Buffett would probably agree in terms of telling how expensive that stock is. So the cheaper the price is relative to those earnings, the better value that we're going to get. So, but does that mean that we should just go and buy all of the lowest PE stocks? Well, not necessarily. That could be one factor that we use. But we also want to look at the growth rate, okay? So if we had a company, for example, that had a price to earnings ratio of 10, but was growing its earnings at 5% per year, that might be fine. But we might have a price to earnings multiple on another stock that might be 40 times, and she's, gosh, that's 4 times as expensive relative to those earnings, but maybe that stock is growing at 50% per year. So those are the factors that are going to come into that. And essentially, what we want to look at is that ratio maybe between what that price is, what the current earnings are, but what is the forecasted growth. And it's that forecasted growth that we were kind of talking about there just a minute ago that everybody is trying to figure out. So if you take a company like Netflix as an example, Netflix has had a very large amount of success, both on the stock performance level, but also as a company, they've been able to grow their subscribers. But Netflix is a very expensive company on a price to earnings ratio. In other words, compared to a company maybe like Ford Motor Company that has a very low price to earnings ratio, Netflix has a very high price to earnings ratio. And so the idea there with that, if you're going to buy a company like Netflix, is you hope that if this is the trajectory that we're going to grow these earnings, I don't know what Netflix growth rate is, but if they're supposed to grow their earnings at 20% per year, and that's what this present value is today on that particular stock, that's going to change pretty dramatically if all of a sudden maybe the subscriber growth starts to slow down and people start to forecast maybe that it's not going to grow at 20% per year, but it's only going to grow at 15%. And so when you take and you present value those cash flows back, that's going to mean the stock today should be less valuable. And that's going to be one of the reasons that the stock price is going to move up and down. Okay, so what we're talking about is probably the number one driver of why stock prices go up and down. And it's really just trying to dissect what are those earnings of the company, what do we think those earnings are going to be over the future, and then present valuing those back. And obviously there's a lot of different factors that go into that. Okay, so let's talk about a few other factors that can influence the stock prices here. So one of those is, what is the company doing with those profits? So one of the things they can do is they can just keep those in the company, and that's something called retained earnings. And so a company that makes a profit can simply put that in their cash stockpile, maybe save it for a rainy day, use it if they have a company that may be more cyclical in nature, where their sales are better at certain times of the year. They can use it to reinvest back in their company, so they can maybe build a new factory, invest in technology or things that can make them more productive. They can also use that money that they make as profits to pay down debt. Okay, so if a company has a lot of debt or some debt on the books and they're paying interest, just like if we wanted to try to improve our personal balance sheets, we could pay down debt, and then those interest payments that we don't have to pay anymore, that'll kind of build and compound into more profits for the company down the road there. They can use it to buy back their stock. And that is something that's actually very popular right now. And it's actually another form of a debt repayment. So one of the things I talked about in another video was how companies are financed, and they can finance themselves through bank loans or through issuing bonds, but they can also finance the company through issuing stock or ownership interest in that particular company. So if a company buys back its shares, that's going to, again, lend itself to future growth of those earnings. So one of the things I want to talk about here as we're looking at this, because what we're trying to do is we're really trying to get the present value of those future cash flows. So we want to understand what the earnings per share growth is. But I think another important factor that we should be looking at is something called revenue growth. And so some of those things that we were just talking about there, where that would lead eventually to higher earnings per share down the road. If we buy back a whole bunch of company stock, there's fewer shares out there, that's going to mean higher future earnings per share for those companies. But what we really want to do is also track and see, is revenue going up? In other words, we could add to the bottom line by paying down debt or buying shares back, but is the revenue actually going up? And if earnings per share is growing at 20% because they're doing some of these other things that are maybe more accounting related, is their revenue also going up by 20%, or maybe the revenue is only going up by 10%. So those are a couple of very important factors to understand as we're trying to make a decision whether we want to buy this company or buy a different company, or how we're going to invest our money in the stock market. So one more thing that a company can do with its earnings is they can pay a dividend. And a dividend is basically just returning some of that capital back to the shareholders. And there's a lot of YouTubers out there, or I should say a few YouTubers out there, that are almost devoting their entire channel to dividend paying stocks, almost like it's the holy grail of investing. And while dividends can be very valuable, especially for people that are maybe getting close to retirement, that want to generate a little bit more income for themselves in retirement, a dividend is just that. It's basically just shifting some of that money from the company's balance sheet over to the shareholders' balance sheet and putting that into your pocket. One thing I do like about dividends, though, is you can't fake them. If they're paying dividend money out to the shareholders, that's not something that can be finagled in any way with the balance sheet or the accounting within the company. Whereas sometimes when you're looking at what a company is doing with its money and it's repaying debt or buying shares back, not to say that companies are doing anything wrong, but sometimes it can be really difficult to really figure out exactly what's going on. Where a dividend, that tends to be a little bit more solid. So let's wrap up here. Let's talk about a couple of other things that really can affect a company. We talked about looking at the company individually, looking at what the products are. So of course, things like the management of the company. That's something that if you have a good management team and they're out there, trying to innovate and they're putting the money towards the right things, innovating the right products, having a good marketing team, those are all things that can really lead itself to that. You look at something that's going on right now with Boeing as an example, not that they did anything wrong per se, but they're having a very big issue. So one of the things with buying individual companies as opposed to buying a basket of companies like through a mutual fund or an ETF is that you're always going to have some individual concerns and risks with an individual company, something that would be completely unforeseen, like in the case of that 737 MAX that's been grounded. They just halted production on that. We're in the end of 2019. Nobody really knows. In fact, the CEO today has stepped down and there's a new CEO coming in. So those are things that we want to look at there. And we saw things like Enron, if anyone can remember that, back in the late 90s, where they were one of the Fortune 100 companies, one of the companies that was really in a lot of portfolios out there growing, but obviously what they were doing within that company was very shady and illegal, and some people went to jail as a result of that, but you do have some of those risks that you need to keep in mind. A couple of other things, though, is industry, okay? So whereas, we do have to look at what factors may influence those stock prices on a company basis, but there's also things that could affect an industry. So for example, commodity prices. So if you're building cars, for example, or you're building airplanes, the raw materials, how much is that steel and aluminum? So if all of a sudden steel prices shoot up, we had some scares with that here recently with the tariffs. In fact, we still kind of do a little bit. What is the price of steel going to be while we're in this trade war with China? And hopefully things get resolved here, and it looks like maybe there is some light at the end of that tunnel. But what are those commodity prices, and is that something that we could pass along to the consumer, or the company can pass along to the consumer if all of a sudden steel prices go up by 15% for whatever reason? So we want to look at that. Also look at what's going on with the industry, regulation. So we had here a lot of the technology companies. We had Zuckerberg, being, asked to testify before Congress, and Google and Apple. And so are these companies, under scrutiny? Is there something that the government could do that could maybe change the way some of these companies operate and maybe some of the future profitability? So there's things that could affect an entire industry. And then also, too, we've got the market as a whole, or the economy. And so some of the things there, we want to look at is, how strong is the consumer? Right now unemployment is very low, the consumer is very strong, but things do tend to go more cyclical. So if we have a product that is, let's say, more of a staple, something like Colgate, Colgate as an example, and they're selling things like laundry detergent and toothpaste, and people buy that almost no matter what's going on with the economy, or somebody's buying cars or computers, something that might be more cyclical. So we want to look at that and look at what may be influenced on a more of a market level. Also, too, things like interest rates, and that's something that is dictated by the market, also dictated a little bit by the Federal Reserve and what their interest rate environment is. The tax environment that we might be in, are taxes going up, are they going down? So we did get a pretty favorable tax cut here in 2018. It was really favorable for corporations. They lowered the tax rate compared to what it was by quite a bit. So that also added to the profitability of really the entire stock market. One of the reasons I think the stock market has been doing pretty well here over the last year and a half or so. So you want to look at those factors. So we have things. We start off at a company level and we look at what's going on individually with those companies. What's the profitability? What are we forecasting the future earnings of that company to be, and how do we present value that back? Do we like the product cycle that's going out? And I think if you're buying individual companies, I think you should like the company, like the products that company has. So if you're going to buy Apple, if you're a PC user but you're buying Apple stock, I don't know if that necessarily matches up. It could work out for you, but I tend to like to buy stocks of companies that I like their products, and I think that's something very, very important to keep in mind there. So everything I've talked about pretty much up until now really has to do with the fundamental analysis. Again, starting with the company level, looking at the industry, and then looking at the economy as a whole. And all three of those things really should be a green light for us, and if we're going to buy shares of an individual company. But really, the last point in this whole thing, and certainly not the least, and I think one of the most important factors, is to look at the technicals of that particular stock. In other words, what we're talking about there is we talk about fundamental analysis versus technical analysis. Fundamental analysis is looking at all those things, the earnings of the company, the management, looking at the product lineup, trying to forecast what those earnings are going to be. But the technicals are just looking at, like we talked about at the very beginning, what is the supply and demand for that particular company, and looking at and maybe trying to identify some of these trends. That's something that we do with the portfolios that we manage. We do it on three separate levels, just like we talked about here. We look at it on a macro scale, so stocks versus bonds versus international, U.S. We look at that. We also look at the industries or the sectors of the market, and are technology stocks doing better than energy stocks or healthcare or financials, and kind of look at where some of the strongest momentum is, or relative strength as we call it, within those individual sectors. And then we can look at it on a stock level as well. And so what we want to look at, essentially, if we're going to buy a stock, and we talked about this in another video, is that stock, is it trending up, or do we have a stock that may be trending down? And the way we do that is we're going to look at this, and I think the best way to think about it are ceilings and floors. Okay, so you think about a stock that may be approaching $100 per share, and it goes up a little bit, and it gets close to 100, maybe not quite there, and then the stock comes down a little bit, and then it comes up, gets close to 100 again, and then the stock price comes down. And so what that's telling us is that, again, it's all driven by the laws of supply and demand. So as that stock is getting close to 100, and that's just an arbitrary number, it doesn't mean that that's when stocks tend to stall out at 100, but as the stock is approaching a certain price point, what ends up happening is buyers come in, or sellers come in, I should say, and saying, hey, that stock has never really been that high before, and looking at the earnings and all the forecasts and everything like that, sellers come in and they start selling that stock, and it pushes the stock a little bit lower. And then that might happen again. It might happen 2 or 3 times over that. So you create this ceiling, where the stock is not really breaking through that. If all of a sudden that stock breaks through that, and we say, hey, it's come up to that level a couple times before, maybe 2 times, maybe 3 times, maybe 5 or 6 times, and kind of the longer that's gone on, the more solid that ceiling becomes. And if it breaks through that, we tend to see that hey, there's a lot of light up here, and so stocks that break through one of those thresholds tend to start moving in an upward direction. On the same token, we could have a stock that maybe has been a little bit downward, and maybe that's coming down to $50 per share, and as the stock is dropping, buyers come in and they support that, and so that that gets a little bit of a lift, and buyers come in, and then maybe it goes up a little bit and then it comes back down, and maybe that happens 2 or 3 times. Again, the same type of thing. If it were to break below that floor or that support level, then we tend to think that that continues, so we want to look at that, and we want to look at the stocks that we're buying, and we want to, first of all, we do want to make sure that we like the company, we like the management, the products, their earnings are going in a good direction, and we have a good present value of those future earnings of that company. But we also want to look and say, is that stock trending in the right direction? And we've oftentimes referred to it a little bit like gardening. So we're going to plant a bunch of seeds. Hopefully those seeds are going to come up as the flowers or the vegetables that we want. So we want to let those things grow as long as possible. But when things do come up as weeds, we want to get rid of those as quickly as possible. So, when a stock that maybe has had some support and it breaks below that before things start really getting bad, we want to maybe think about, is it time to sell that stock? Is there something fundamentally that's changed with that company, or are the laws of supply and demand trying to tell us something that that maybe the fundamentals don't show yet, and that's something that happens a lot, where maybe certain people that are maybe a little bit more on the inside, not necessarily insider trading, but more familiar with the industry or more familiar with that particular company, that says, hey, this stock is great, but I'm seeing that there's a lot of competition coming into this, or the technology that this company is using and selling is going to be obsolete because something new is coming in. And maybe sometimes that's not always apparent to the analysts on Wall Street. So, coming back to that technical side is kind of the last factor there. And so again, we're looking at, why do stock prices move up and down? It has to do with those laws of supply and demand, but there's a lot of other factors that go into that. So anyway, I hope this has been helpful. This is a video that I've wanted to do for a while. I hope some of my points came through and made sense to you. If you like the video, then please hit that subscribe button, the little notification bell next to that, so that anytime we upload a new video, you're going to get notified when we do that. We're trying to be a lot more consistent with the videos that we're uploading, usually 2 or 3 times a week. And we've also got some longer format live streams that we're going to be planning as well. And that's going to be broadcast through our Money Evolution Resource Center. There should be some links below that you can get into that. It's totally free to join that. But then any of those monthly live streams that we do will pop into your feed. So anyway, with that, have a great day. Hope you liked the video, and I'll see you back here soon. Thanks.